The property market has taken a dive across the country.
Property prices.
The property market, house prices, like a balloon that's deflating very quickly.
Is Australia's housing market about to collapse? It's the question everyone is wondering this week, as new data shows some of the world's hottest property markets seeing significant declines in prices on the back of surging inflation and rising interest rates. Property is considered to be one of the safest long-term investments, but Australia's real estate market is uniquely exposed to the particular economic crisis that is plaguing many regions around the world, with some experts now suggesting that house prices could fall as much as 43% over the next 3 years. Today, I'm going to be explaining everything you need to know about the current state of the Australian housing market and where it might be going in the future. Some of today's research was done in Seeking Alpha, a fantastic resource for stock and market analysis and news. You can start your free trial today and get a whopping 58% off your subscription by signing up at hamishhotter.com/Seeking Alpha. The link is also in the description below. In many parts around the world, investing in property is considered to be one of the safest long-term investments. And this is particularly the case in regions with strong and developing business districts, where constant and increasing demand for housing supports rental increases and drives higher prices. According to Aussie Home Loans, the Australian national median house value has increased 412% over the past 25 years. That represents a per year increase of almost 7% and was achieved with very little volatility. Also, the nature of a real estate investment make it very attractive, particularly for people looking to start building their retirement portfolio. Unlike the stock market, you can't wake up, see some bad news, panic, and sell your house within a few minutes, which forces an element of patience and discipline that might not come naturally to a lot of novice investors. Plus, having access to low interest debt essentially creates a forced savings account where people who are invested in a property are forced to take money out of their income and essentially put that money in the property, where it's less likely to be spent than if it was just in their savings account building up over time. But property is like any other risky asset. There are pressure points, certain factors, government policies, economic environments that make the investment more fragile, and the Australian market in particular is in a very vulnerable position. To paint a picture of why house prices are declining today, I'm going to take us back to before the pandemic. In Australia, owning a piece of property is a central part of many people's investment portfolios, and most people do this through the use of debt. In Victoria, for example, only 32.5% of houses are owned outright, and across Australia, almost 70% of properties have a mortgage against them. That's about 6 million mortgages among a population of 20 million adults. And unlike the US, Australia doesn't really have long-term fixed mortgages. While in the US in 2020, you could have locked in a 2.2% 30-year fixed mortgage, in Australia, most commonly, we're going to be fixing rates on a mortgage at somewhere between 2 and 4 years. And this is a big difference because it means people in Australia who locked in, say, a 2.2% rate for a 2-year fixed period, those people will eventually be exposed to the higher rates we're seeing today. We'll come back to this in a minute because it might actually shock you how much some people's mortgages are going to be going up once those fixed rates roll over. But these 2 to 3%, 2 to 4 year fixed mortgages were particularly popular during 2020 and 2021 because, especially in markets like Melbourne and Sydney, where prices are really, really high, it's been so difficult for people to get investment in those markets, and having a loan that has such a low rate has allowed some people to finally get into the market. But it also means that now Australians are spending a significant portion of their income towards their housing. According to the ABS, the Australian Bureau of Statistics, 15.5% of mortgage holders spent more than 30% of their income on housing. Oh, and here's one more crazy statistic for you. 50% of you guys are not subscribed to the channel. So if you're enjoying this video, these videos take a lot of research and a lot of planning and a lot of my time to put together. So if you do enjoy it, I would very much appreciate it if you could just hit that red subscribe button below. It helps me out a ton. It tells YouTube that you enjoyed the video and allows YouTube to, or encourages YouTube to send it out to other people. So if you can do that and you're not already subscribed, I really appreciate it. But moving on, then we have something called negative gearing. Negative gearing is a tax rule in Australia which essentially allows investors to deduct the loss between the rental income and the cost of running a property. So for example, if the interest expense on a loan that you took out to buy a property is more than the rental income you're getting from that property, then you can deduct or subtract the difference from your taxable income. Negative gearing helps to fuel the property market during economic growth, as it essentially encourages investors to buy into properties that are not cash flow positive yet. And while investing in cash flow negative assets is something that I tend to avoid, when it comes to the property market, it can make sense in some circumstances. Australia has some of the most desirable real estate in the world, so it's pretty reasonable to project that rental income and house prices will rise at least in some areas, which makes negative gearing on a property rational. But the effect of negative gearing can also work in the opposite direction during an unstable property market. If costs are rising and house prices are falling, it can actually fuel additional selling from investors. And that instability began in 2021 with post-pandemic inflation. After briefly entering deflation during 2020, inflation quickly rose above the healthy 2 to 3% range by the middle of 2021. And there were quite a few different factors that contributed to this rapid increase in inflation. For starters, after the world had essentially shut down and then booted back up again, businesses needed time to get their production back to where they were previously. At the same time, the global shipping and freight industry was facing severe bottlenecks coming out of the pandemic, and those factors combined to form a supply shock which created the first wave of inflation. And wave is actually a pretty good analogy because a supply shock or a price increase at the manufacturing level then kind of flows through to the distributors, who flow through to the retailers, and eventually it ends up in higher prices for finished goods for consumers. To make matters worse, Australia was also experiencing a surge on the demand side. Like many major countries, Australia did their best during the pandemic to give stimulus to people who couldn't work and had to stay home, and that was a lot of people in Australia considering the huge number of complete lockdowns that we went through, particularly in Victoria. So coming out of these lockdowns, Australians were eager to get back into the world, and they also had the higher level of savings to do it. Of course, there are other factors that I'm not talking about here, but ultimately all of these things drove inflation higher. And if you're someone who's followed what Ray Dalio has been saying over the past few years, then this cause and effect that we've seen from the pandemic and the following inflation shouldn't be something that's too surprising. It's a fairly normal economic circumstance. What wasn't expected was that on top of that, a military conflict would also exacerbate inflation to levels that we haven't seen since the 1980s. Beginning in 2022, a military conflict between Russia and Ukraine drove a second and larger supply shock, this time in the energy market. The energy market in areas all around the world was already facing some trouble out of the pandemic, and that's essentially because there was such a severe drop-off in demand for oil, for example, during the pandemic. And again, there was a slow move for production to ramp back up for oil, essentially causing another supply shock. In Australia, this drove automotive fuel to increase over 35% in the last 12 months. And that has contributed in a big way to the headline inflation rate in Australia, which is currently 6.1% as of June 2022, although that figure is expected to be much higher when the latest data comes out in just a few weeks. So what has all of this got to do with the housing market? Well, the best way that we know to reduce inflation is for the Reserve Bank of Australia to increase their official cash rate. The official cash rate is the overnight borrowing rate for banks. At the end of each day, banks need to process transactions, and they can borrow from other commercial banks at the official cash rate. When the RBA increases the official cash rate, it increases the cost of borrowing for banks, which they pass on to their customers by charging higher interest rates on their products, such as business loans or mortgages. And this helps to slow inflation because the higher cost of debt slows investment and consumer spending, bringing demand back in line with supply. This, of course, has a very real and distinct effect, particularly on people with mortgages with no fixed rate or a fixed rate that is set to expire in the near future. Throughout the pandemic, the official cash rate was set to 0.1%, meaning that borrowing money was essentially free for banks, and it's why home loans were going for such low rates. This has now increased several times to 2.35% today and has had a big impact on the cost of a home loan. For example, in 2021, a 2-year fixed rate was just 2.2%. Today, it averages 5%, and a 5-year fixed rate was 2.6% in 2021. Today, it averages 6.3%. That's more than a doubling in the amount of interest that someone has to pay on their home loan, and it's about a 35% increase in their overall payments if you include principal, which of course does not go up when you increase interest rates. The principal amount of loan that you owe stays the same. And higher payments on mortgages really has two effects. One is that it makes real estate investments less attractive, or in other words, essentially the higher cost of borrowing money means that prices need to come down to increase that rental yield to bring it in line with the additional cost of debt. The other effect is that the increased payments could actually force people to either default on their loans or at least have to sell their property. And both of these factors, of course, can lead to lower house prices, which is exactly what is happening. During September of 2022, Australia saw a 1.4% decline in property prices, bringing the quarterly decline to 4.1%, although prices remained 1.7% higher than last year. But the story in hot property markets such as Melbourne and Sydney is a little different. Melbourne declined 1.1% for the month, but is down 3.7% for the quarter and 3.9% down for the year. Sydney is the worst of the lot, down 1.8% this month and down 6.1% for the quarter. So what happens next? Well, a lot of what happens next really depends on what happens to inflation over the next 24 months, and then how does the RBA, the Reserve Bank of Australia, react to what inflation did over the next 24 months. Economic research firm Digital Finance Analytics modeled a scenario where the official cash rate set by the RBA is increased to 4%. Under their modeling, this would put mortgage rates at about 7% and cause as much as a 43% decline in house prices in 2025. The firm noted that this is unlikely and that it would be, in their words, catastrophic for many people if this happened. And while that is absolutely true, it would be devastating if interest rates continue to rise. I don't think it's out of the realm of possibility, considering that it would still be far below the long run average of over 5% that Australia has seen from the official cash rate. The US, by comparison, which has had stronger inflation to be fair, will likely pass 4% on their interest rate in the next few months. So while this kind of scenario where interest rates go as high as 4% or even higher, while it is less likely, I don't think it's completely out of the question. What is certainly up for debate is how much property prices would fall if mortgage rates did go to 7%. That's something that we could speculate on, but no one really knows the answer to. Martin North, head and founder of Digital Finance Analytics, also modeled two more scenarios. His best case assumes the official cash rate remains below 2.5% and then declines somewhat next year, which would be likely if inflation dropped off significantly, for example. Under those assumptions, he sees house prices falling just a few percent over the next year before rising again. And then under his most likely model, where interest rates rise to 3.5%, but a recession is avoided, under those circumstances, he sees house prices falling 9% next year and then dropping as much as 24% in 2025. The bottom line about all of these predictions of what might happen in the future, the bottom line is that they all depend on predicting something that we can't predict, and that is what inflation does. And we can really summarize what is going to happen with the Australian property market as this. If inflation for the long run continues to be well above the 2 to 3% healthy range, then the Reserve Bank of Australia will likely want to and need to increase their official cash rate, and that will continue to hurt the property market for as long as that goes on. But regardless of what the broader market is doing, on an individual basis, if you are invested in a property, your only main concern is, can you continue to make payments over time? And that's because regardless of what happens in the short term, Australia has been and will likely continue to be one of the best places to own property in the world, particularly certain parts of Australia. So if you can continue to make your payments, then what someone is willing to pay for a property in the next year or the next 2 years is completely irrelevant to you.